All right, welcome everybody. We are hungry for Moat, and we encourage you to be as well. Very important. I'm Prabhat. This is my friend Avinash, and we are going through the Buffett partnership letters. And today we will be discussing the 1963 letter, and or the letter covering the 1963 year, and the latter half, the last 6 months of the letter. And just to kind of recap briefly, in the first half of the year, the letter for that, he discussed the Dempster situation. He had bought into this company via the partnership, and I think he tried to run the business, improve the operations, but then he pivots a little bit, or and then kind of sells off a lot of the assets that were not very productive. He hires CEOs because he doesn't want to do all the work, and he praises that person for doing a really good job.
Hmm.
He sells a lot of the assets, like he trims down the fat, still leaves the core of the business operational. That's the highly profitable part, and takes the extra cash and buys stocks because that's what he's best at.
Yep. And also during this context, he's moved in with his dad for his new firm, and so it's a little bit of a bigger place, but very modest. He's really killing it in the game, but he says he's got free Pepsi if people want to come see it, but really very frugal. Overhead is very low right now. His dad is also there with him, so it's kind of a nice little partnership. And yeah, really, in the past, he's been killing it. He's been outperforming the market since the day he began his fund. He's never had a year where he hasn't beaten the S&P 500 or the Dow Jones that he's comparing
Correct. I
himself with.
mean, it's kind of clear. I mean, like he knows what he's doing. I mean,
Yep.
it would be silly if at this point you knew his track record and weren't tempted to invest with him. I think for us, the bar or the barrier would have been like we wouldn't have enough money to invest with him.
That's
So,
right. That's right. Yeah. And we would probably, in all honesty, be very distracted. Space race is going on, all this semiconductor stuff is going on. We'd be probably like, wow, this new tech thing is the hottest thing. Forget about this one dude in Omaha. What's going on?
that's true. It's probably like
Yeah.
the cloud and the crypto, the blockchain
Equivalent.
of today. Like
Yep.
how that's where most of the money is.
Yep.
And those industries will change the game, like the semiconductor and the space. Well, I guess space races still trying to change the game, but
Yeah.
but
Yeah.
but cool stuff.
Yeah. For sure.
All right, let's let them go ahead and get started. Let's start us off with our performance in 1963. 1963 was a good year. It was not a good year because we had an overall gain of uh, $3.5 million, or 38.7% of our beginning net assets. Pleasant as that experience may be to the pragmatists in our group, rather it was a good year because our performance was substantially better than that of our fundamental yardstick, the Dow Jones Industrial Average. If we had been 20%, if we had been down 20%, the Dow had been down 30%, this this letter would have begun 1963 was a good year, regardless of whether we are plus or minus in a particular year. If we can maintain a satisfactory edge on the Dow over an extended period of time, our long-term results will be satisfactory, financially as well as philosophically. So that's kind of self-explanatory. Looks like they killed it. We'll see the
Yep.
results in a bit, but continues to say, their goals are like 10%
Mm-hmm.
better than the Dow. Or doesn't matter who's positive, who's negative.
Yep.
To bring the record up to date, the following summarizes the year-by-year performance of the Dow, the performance of partnerships before allocation to the general partner, and the limited partners results for all full years of Buffett Partnership Limited's and predecessor partnership activities. I like how there's only one general partner. So looking at this chart, starts from the beginning when he started this partnership. I mean, Dow is kind of bipolar, like he says. It says market is bipolar person who's just randomly saying things are worth more and less. Looks like overall it's going positive,
Mm-hmm.
but definitely some negative years, and most recent being 63 was 20% up. And
Yeah.
if you see, I mean, a lot of the positive years are so huge.
Yeah.
30, 38, 20, 22. I mean, these are incredible bull years.
Yeah. What's interesting here is that I thought previously we had seen even the partnership have a negative year, but not as negative as the Dow. But in
No, the
column two,
partnership has never had a negative year.
oh, really? Okay. Okay.
Yeah,
Wow.
that even when the Dow has been negative.
Mm.
And so yeah, I mean, if we are Buffett, trying to do the compounding, this is what the results should be like. And
Yep.
I mean, up to 40% a year. I mean, that is just
Incredible.
ridiculous. Yeah,
Yeah.
the worst year is 13.9%. I mean, I'm hoping of 15% every year. That's my goal. I guess they'll do
Mm-hmm.
10% a year.
Mm-hmm. Yeah, even if you compared it to like the standards of the S&P 500, where the average would be 10%, he's still outperforming that. Even in the worst year of 57.
Oh yeah, yeah.
Yeah.
And then limited partner if you were not the capital allocator and stockbroker, if you just invested with him, given Buffett's you know rules of share profit sharing after
Mm-hmm.
6%. I mean, it's still a no-brainer. Just give him your money, go to beach, and just
Yep.
just just ensure a
Yeah.
good retirement.
Yeah.
I'm just gonna skip this part. I think
Sure.
it kind of just goes over the chart. One wag among the limited partner has suggested I add a fourth column showing the results of general partner. Let's just say he too has an edge on the Dow.
The fourth column.
The following table shows the cumulative compounded results based on preceding. Oh, he doesn't want to. He doesn't want to add that. He basically what how has Buffett been doing? How much money?
Oh, I see. Okay. Okay.
And it's like, let's just say he too. He's also doing better to the Dow. Okay,
Yeah.
right? That's it. Let's not focus too much.
My understanding was that his one, if you go up a little bit, so my understanding was that the partnership results was his returns as well.
No, no, he's not talking about Buffett's money. Let's say he put in $1 million
Ah,
in
I see.
partnership. Like, what is like his is compounding that much, plus he's getting some from the limited partners.
Gotcha.
So he's doing
Yep.
better than everybody.
Yep. Yep. Awesome.
This is a cumulative chart. I mean, this is going to be more interesting at the bottom here. 1957 to 63, cumulative markets up 95%.
Mm-hmm.
You know, partnership as a whole is, 450%. This is ridiculous to say it. A limited partner is over 300%.
Incredible.
Compounded annually 27% for the partnership, and limited partners get 22%. I mean, that's pretty good. Can
Mm-hmm.
can argue with that. I mean, solid returns.
Mm-hmm.
It appears that we have completed 7 fat years with apologies to Joseph. We shall attempt to ignore the biblical script. Okay, that's kind of lost on me, but interesting. Never gone overboard for Noah's ideas of diversification either. So,
That was pretty good.
in a more serious vein, I would like to emphasize that in my judgment, our 70.7 margin over the Dow Shunabaz is unattainable over my long period of time. A 10 percentage point average would be a very satisfactory accomplishment, and even a much more modest edge would produce impressive gains, as will be touched upon later. This view, and it has to be guesswork, informed, and otherwise carries with it the corollary that we must expect prolonged periods of much narrower margins over the Dow, as well as at least occasional years when uh, our record will be inferior. perhaps substantially so to the Dow.
Mm.
Much of the sermon is reflected in the ground rules sent to everybody in November, but it can stand repetition. Investment companies. We regularly compare our results with the two largest open-end investment companies, mutual funds that follow a policy of being typically 95 to 100% invested in common stocks, and the two largest diversified closed-end companies. Uh, these four companies: Massachusetts Investor Trust, Investor Stock Fund, Tricontinental, and Lehman Corp, managed by $4 billion and are probably typical of most of the $25 billion investment company industry. My opinion is that their results roughly parallel those of the vast majority of other investment advisory organizations, which handle in aggregate vastly greater sums. The purpose of this, or the purpose, or I think of, excuse, not this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index or investment achievement. The advisory talent managing just the four companies shown commands annual fees of over $7 million, and this
Mm.
represents a very small fraction of the industry. The public batting average of this highly paid talent indicates that they achieve results slightly less favorable than the Dow. Both are, and I'll just hold it and I'll kind of just reiterate on my own. Like this, I love that the Buffett is so respectful of the index.
Mm-hmm.
I mean, because ultimately one of the arguments against Buffett is, well, what about the index? You can never beat the market.
Mm-hmm.
And I'm personally, believe in Bogle. I work with Vanguard, and the fact that he doesn't just, like just say, whatever index is for stupid people. The fact that in the '60s
Mm-hmm.
is telling you Dow is no pushover.
Mm-hmm.
That is incredible. I think it's just, and then he still goes to beat the market.
Mm-hmm.
Like
Yeah.
he's clearly already in his 30s, thinking, well, if Buffett wasn't doing what he's doing, the next best thing is probably the index,
Mm-hmm.
and that make clicks with me.
Yep. Yep. I love that. But he does say if you are a capital allocator or if you have your own hedge fund, diversification is the worst thing you can do. You know.
If you know what you're doing. If you don't know what
Right.
you're doing, then diversify, or better yet, just get the index.
Yep. Yep.
Both our portfolio and method of operation differ substantially from the investment companies in the table. However, most partners, as an alternative to their interest in the partnership, would probably have their funds invested in media, producing results comparable to investment companies, and I therefore feel we offer a meaningful standard of performance. That's fair.
Ooh, let's check. So these are actually his holdings over the years and compared against the Dow and the limited partners. So let's see where he
Hmm.
got most of his gains from. Maybe all of them are
No, these are just
pretty.
he's just comparing them to the index and the mutual funds, right?
Oh, right. I'm sorry. Yeah. So these are actually other hedge funds, Lehman,
Correct.
Tricontinental, Investor Stock. Okay. So this is not his main portfolio. Yep. Okay. Gotcha.
Correct.
So let's see. Even compared to the other ones, he's still kicking butt. It sounds like because everyone is in the negative while
Yeah.
Buffett's in the positive for a
And
few
even
years.
like the last year, I mean, looks like Dow is about 20,
Yep.
Buffett
Yep.
has a limited partnership. He's not even comparing himself. Like, this is comparing what the limited partners got, not even what the general, like, what partnership did as a whole.
Yep.
He's already looking at the lower end of the spectrum.
Yep. Yep.
And yeah, I mean, Lehman looks like all of them are less than that, less than Dow, except for Layman, but then these also have fees attached to them, and even Layman is like, it's right now it's above, but the year before it was much worse than the Dow. So
Yep.
crazy. Okay.
Okay, compounded. Here we go. So almost twice as much as what you would get against the Dow, and even more for comparing against the others. Actually, this is pretty important to talk about. So, most of us, I think, if we are not managing your own funds, usually you tend to go to one of these kind of bigger mutual fund folks,
Hmm.
and then
Hmm.
they have managed fees on top of it. And then you can see clearly here that even if so on top of the gains that they give you, you're going to have to pay the transaction fee or whatever it is, or maybe the management fees. But the worst part about it is that even those guys don't do as well as the Dow. So if you just did nothing, put all your money in the S&P 500, you'd get close to 10% over around 10 years or so. But you can see here, Buffett, of course, is the exception, but maybe it's a good lesson in that the Dow is very hard to beat.
Yeah, I mean 10%.
Yeah.
That's great. I mean, and that's without fees. I mean,
Yeah.
that's very important.
Yep.
Given, I mean, they say when you're compounding over long periods of time, I mean, even one like 2, 3%, um, a higher return over long periods of time makes a huge difference. And Buffett is doing more than 12%. I mean,
Incredible.
and that's
Yeah.
for limited partners. He's doing a lot more for
Yep.
himself.
Yep.
Okay. Um, the Dow, of course, is an unmanaged index, and it may seem strange to the reader to contemplate the high priests of Wall Street striving vainly to surpass or even equal it. However, this is demonstrably the case. Moreover, such a failure cannot be rationalized by the assumption that the investment companies et al. Are handling themselves in a more conservative manner than the Dow. As the table above indicates, and as more extensive studies bear out, the behavior common stock portfolio managed by this group on average have declined in concert with the Dow. By such a decline of behavior in declining markets, our own methods of operation have considerably more conservative than the common stock component of the investment company or investment advice group. While this has been true in the past, there obviously can be no guarantees about the future. Um, the above may seem like a rather strong medicine, but it is offered as as a factual presentation and in no ways as criticism. Within their institutional framework in handling the many billions of dollars involved, the results achieved are the only ones attainable. To behave unconventionally within this framework is extremely difficult. Therefore, the collective record of such investment media is necessarily tied to record of the corporate America. Their merits, except in the unusual case, do not lie in superior results or greater resistance to decline in value. Rather, I feel they earn their keep by the ease of handling, the freedom from decision making, and the automatic diversification they provide. Plus, perhaps most important, the insulation afforded from the temptation to practice patently inferior techniques which seem to entice so many would be investors. I think is what he meant. Incredible. I mean, first of all, he's like, well, I don't think these big hedge fund managers or big fund managers are evil. I mean, that's the only thing you can do when you're given billions of dollars to invest, and not many billions. And in today's world, it will be probably close to $1 trillion, I would imagine. Like, what else can you expect? You will be tied to that basically an index,
Yeah.
and you're not really earning the fees are not really because you can be realistically expected to beat the market, but everyone should understand the fees are just for the service of that you don't have to think about the money. Like someone's doing it for you, and you don't have to be tempted to do stupid things that would be counterproductive.
Yep. Yep.
It's pretty good advice.
Yeah.
Joys of compounding. Now, to the pulse quickening portion of our essay last year, in order to drive home the point of compounding, I took a pot shot at Queen Isabella and her financial advisors. You will remember they were Euclid into such an obviously low compounding situation as the discovery of New Hampshire. Since the whole subject of compounding has such a class ring to it, I will attempt to introduce a little class into this discussion by turning to the art world. Francis of France paid 4,000 ekus in 1540 for Leonardo da Vinci's Mona Lisa. On the off chance that a few of you have not kept track of fluctuations of the IKI 4000, converted out to about $20,000. So he basically paid $20,000 in 1540 for Mona Lisa. That's a lot of money.
Yeah, for Mona Lisa. But for the Mona Lisa, you know.
I mean, I looked at Mona Lisa. I don't really. I'm not.
You don't get it. You're not an art guy.
That's true. If Francis had kept his feet on the ground and he and his trustees had been able to find a 6% after-tax investment, the estate now would be worth something.
Oh my God.
Dude, what is that?
1 trillion, I want to say. 1, 2, 3, 4,
I think
5,
that's
6.
a million. That's a billion. 1,000 trillion. Oh, that's 1 quadrillion. Or
1 quadrillion. Over 3,000 times.
The present national debt of, if you only knew.
Oh, wow.
What the national debt is now. That will be about, I think national debt, I don't know what the national debt, maybe 20, 30 trillion. I don't know. It's just some ridiculous number.
Yeah.
So it's just like maybe 20 times national debt, not 3,000, but maybe 20 times.
So,
All from 6%. That's true, just 6%. I trust this will end all discussions in our household about many purchase of paintings qualifying as an investment. So it's true though. Like now there are all these, like I listen to a lot of
NFTs and
podcasts,
stuff.
right? No, it's not a podcast. Like now there are all these companies. There's some companies, Master something, that's wanting you to give them money and they will invest on your behalf into art.
Yes.
Like, and I'm like, what is going on in this world? There's way too much liquidity going on, and this is what we come up to.
Yeah, it's actually kind of crazy. But I know some smart people who are investing in that. But even that, like, I don't know if you know Not So Boring, the blog from Pat McCormick. So he invests in a small, I'm sure it's a very small fraction of his complete investment. But it's interesting that they're getting these like ETFs for everything. I think there's going to be like a NFT ETF or something that you can invest in, and it's a crazy world out there. I don't understand what's going on.
I mean, if all these things weren't there, even crypto, all this money would be in stocks. So stocks would be even more overvalued. I mean, the good thing about these things is keeping money out of stocks.
Yep.
That's so much. Well, that's a soap opera, but interesting.
Yeah.
So I mean, stupid simple way of generating, generational wealth. Find a country that you think would be, around in like 400 years, buy the index funds and shut up. Right? I mean, only downhill. Like, I don't know if I'll do that to France, probably. I mean, France is stable, but like, I mean, United States probably is going to be a thing for at least next 400 years.
Yep.
And China is probably the only, contester, but I don't think they're gonna kill the United States. I mean, but this reminds me of the new Ray Dalio book. It's pretty. I try to read it. Pretty good about changing world order. I think it's basically about rise of China.
Yeah.
Just came out like a month or two ago. Okay, back on this. Get a lot distracted easily. However, as I pointed out last year, there are other morals to be drawn here. One is the wisdom of living a long time. The other impressive factor is the swing produced by relatively small changes in rate of compound. Below are shown the gains from $100,000 compounded at various rates. Um, 10 years at
Wow.
4% is 40,000, 48,000, and if you go the other, 16% at 30 years and like 8 million. I mean, it's like yes. So clearly, we know this. There are only two factors in compounding: the time and your compound rate,
Yep.
and they both matter.
Yep.
And they kind of compensate for each other too, if you can. It is obvious that a variation of merely a few percentage points has an enormous effect on the success of a compounding program. It is also obvious that this effect mushrooms as the period lengthens. If over a meaningful period of time, Buffett partnership can achieve an edge of even a modest number of percentage points over the major investment media, its function will be fulfilled. Some of you may be downcast because I have not included in the above table the rate of 22% mentioned on page 3. This rate, of course, is before income taxes, which are paid directly by you, not the partnership. Even excluding this factor, such a calculation would only prove the absurdity of the idea of compounding at very high rates, even with initially modest sums. My opinion is that the Dow is quite unlikely to compound for any important length of time at the rate it has during the past 7 years. And as mentioned earlier, I believe our margin over the Dow cannot be maintained at its level to date. The prior to this assumption would be a materially lower average rate of compound for Buffett Partnership Limited in the future than the rate achieved to date. Injecting a minus 30% a year, which is going to happen from time to time into our tabulation of actual results to date, with, say, a corresponding minus 40% for the Dow, brings both the figures on the Dow and the PBL more in line with longer range possibilities. As the compounding table above suggests, such a lowered rate can still provide highly satisfying long-term investment results. Again, more like, please don't freak out. We're not going to be able to do this long term. There's going to be a down year. I basically know it will happen. I just don't know when. And if it happens, no big deal. It will still be awesome.
Good summary.
Right?
Yeah.
Our method of operation. At this point, I always develop literally what schizophrenia. on on the one hand, I know that we have in the audience a number of partners to whom details of our business are interesting. We also have a number to whom this whole thing is Greek and who undoubtedly wish I would quit writing and get back to. And yes. To placate both camps, I am going to sketch briefly our three categories at this point, and those who are interested in getting their doctorate can refer to the appendix for extended examples. Ooh, that sounds like
That's
us.
going to be fun.
Our three investment categories are not differentiated by their expected profitability over an extended period of time. We are hopeful that they will teach over a 10 or 15 year period produce something like the 10 percentage point margin over the Dow. That is our goal. However, in a given year, they will have violently different behavior characteristics depending primarily on the type of year. It turns out to be the stock market generally. briefly, this is how they shape up generals. I'm just going to go over some of this stuff again. Category of undervalued. Stocks determined primarily by quantitative standards, but with considerable attention to also paid to the qualitative factor. This is often little or nothing to indicate immediate market improvement. The issues like glamour or market sponsorship, their main qualification is a bargain price. That is an overall valuation on the enterprise substantially below what careful analysis indicates as value to a private owner to be. Okay, let me tell you something. Well, yeah, since this, you know what this indicates?
No.
This basically, to sum it down, means he's buying things at PE value of less than 7.
Oh, really?
Kind of, yeah. That's kind of what it roughly kind of equates to. Substantially below PE 7.
Wow. Okay. How do you know that?
Just like that in America, corporate America, investing PE of 15 is considered to be average public. PE of, yeah, average value for a public company, and 7 has to be average value to a private company.
Really? Wow, 7. I don't think I've come across any stock. I don't even think I'm
Yeah,
pitching for anything less than
substantially
15.
lower.
Yeah, wow, that's
And now
incredible.
these are probably not growth stocks,
Yeah,
granted, but
yeah.
like, so, but
Wow,
still, this is how cheap Buffett is.
that's incredible. 7, almost half of what's considered average. Wow.
Again, let me emphasize that while quantitative comes first and is essential, the qualitative is important. Ooh, so it's not just about cheapness. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dormant management or stockholder group. But we demand value. The general group behaves very much in sympathy with the Dow and will turn in a big minus result during the year's substantial decline by the Dow. Contrary-wise, it should be the star performer in a strongly advancing market over the years. We expected, of course, to achieve a satisfactory margin over the Dow. Workouts, these are securities with a timetable. They arise from corporate activity, sellouts, mergers, reorganizations, spin-offs, etc. In this category, we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activities of this sort. We wait until we can read it in the paper. The risk pertains not primarily to general market behavior, although that is sometimes tied in to a degree, but instead to something upsetting the apple cart so that the expected development does not materialize. Such killjoys could include antitrust or the other negative workout, other government action, stockholder disapproval, withholding of tax rulings, etc. The gross profits in many workouts appear quite small. A friend refers to this as getting the last nickel after the other fellows has made the first 95 cents. However, the predictability coupled with the short holding period produces quite decent annual rate of returns. This category produces more steady absolute profits from year to year than the generals do. In years of market decline, it piles up a big edge for us. During bull markets, it is a drag on performance on a long-term basis expected to achieve sorry, same sort of margin over the Dow attained by generals. This line here uh, basically sounds like, how companies announce mergers, like something's going to buy, and the stock price, let's say, um, let's announce that what is a merger that happened to public companies? Uh,
Um, let's say,
Apple
and
bought or Amazon bought Whole Foods.
yep.
Let's say bought at, you know, $38. I
Mm-hmm.
don't know what the prices were. And let's say the Whole Food stock was $32.
Mm-hmm.
After the announcement in the papers, the stock will immediately jump to $37.9.
Mm-hmm. Mm-hmm.
It won't be 38. So
Mm.
there's always with a small buffer. And that
Mm.
buffer keeps getting smaller and smaller as people start using robots and technology to trade.
Mm. Okay, but why is that jump there initially?
Because it's basically guaranteed. Like Amazon has declared they're gonna buy Whole Foods for $38 per share.
Okay.
And they was trading at 34, let's say whatever.
Mm-hmm.
Like if you buy it, you're guaranteed that Amazon's gonna pay you 38.
Mm-hmm.
You're guaranteed that profit, and you know when the merger will happen. I mean,
Mm-hmm.
you may not know when, but like it's planned.
Mm-hmm.
So that's kind of taking that's kind of the bucket Buffett is
Mm.
talking about. But I think it's harder of those sorts of things now, given
The
like you're
automatic
not,
trading and stuff.
yeah, you're not waiting for everybody to read it in the paper and then make
Mm-hmm.
the phone call. It's most likely like as soon as it's listed on the SEC website,
Mm-hmm.
the computer has already made its trades.
Mm-hmm.
But there are other types in this category that are not as automated.
Mm.
Um, Vast majority will be, but some will not be. Where you have industry specific knowledge, so you can still use the strategy to make money, but it's a lot more work.
Mm.
Controls, these are the rarities, but when they occur, they are likely to be of significant size. Unless we start off with the purchase of a sizable block or stock controls developed from the general category, there is of situations where a cheap security does nothing price-wise for such an extended period of time that we are able to buy a significant percentage of the company's stock. At that point, we are probably in a position to assume some degree of perhaps complete control of the company's activities. Whether we become active or remain relatively passive at this point depends upon our assessment of the company's future and management's capabilities. The general we have been buying the most aggressively in the recent months possesses excellent management following policies that appear to make very good sense to us. If our continued buying puts us in a controlling position at some point in the future, we will probably remain very passive regarding the operation of this business. We do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings. Active or passive, in a control situation, there should be a built in profit. The sine qua non of this operation is an attractive purchase price. Once control is achieved, the value of our investment is determined by the value of the enterprise, not the oftentimes irrationalities of the marketplace. Our willingness and financial ability to assume a controlling position gives us two-way stretch on many purchases in our group of generals. If the market changes its opinion for the better, the security will advance in price. If it doesn't, we will continue to acquire stock until we can look to the business itself rather than the market for vindication of our judgment. Investment results in the control category have to be measured on the basis of at least several years. Proper buying takes time. If needed, strengthening management, redirecting the utilization of capital, perhaps affecting a satisfactory sale or merger, etc., are also all factors that make this a business to be measured in years rather than months.
Mm-hmm.
For this reason, in controls, we are looking for wide margins of profit. If it looks at all close, we pass. This sounds like for controls, there must be huge money making opportunity.
Yeah, but
Right.
he doesn't want to usually, right? I mean, he wants to take it a hands-off approach. He doesn't really want to get involved actively.
Yeah.
Um, yeah.
It's a very patient. It costs a lot of time and
Yep.
energy if you do it the full
Yep.
control way,
Yep.
and distracts him. While he's focused on that, he probably can't analyze as many companies as he wants to.
That's right.
Controls in the buying stage move largely in the sympathy with the Dow. In the later stage, their behavior is geared more to that of workouts. Makes sense.
Mm-hmm.
As I mentioned in the past, the division of our portfolio among the three categories is largely determined by the accident or availability. Therefore, in a minus year for the Dow, whether we are primarily in generals or workouts is largely a matter of luck. But it will be a great deal to do with our performance relative to the Dow. This is one of many reasons why a single year's performance is of minor importance uh, and good or bad should never be taken too seriously. If there is any trend as our assets grow, I would expect it to be towards controls, which heretofore have been our smallest categories.
Makes sense.
I may be wrong in this expectation. A great deal depends, of course, on the future behavior of the market, on which our guess is as good as mine. I have none. At this writing, we have majority of our capitals and generals workouts ranked second and controls ranked third. What the heck?
It kind of makes sense.
Yeah, but he basically said as we continue to do better and grow, we will have more and more controls. What the heck? So he's already planning on a Berkshire thing.
Wait, no, I misunderstood that then. My understanding is that his main thing is mainly generals, then workouts, then controls, right?
No. As this trend grows, I would expect it to be towards controls.
Oh, oh, interesting. Okay, so that might mean that he might buy out the company outright if he thinks that it's a good idea, but I don't think in the strictest sense of like um, having control over the management or anything. I think he's just saying it might be a good business. Whatever they get in revenue, we'll just use it for other investments.
Yeah, but as our assets grow, you should expect we will be doing more activity in controls.
And just for definition, the controls is just when he doesn't want to active. I mean, maybe he does want to, or
No,
hopefully he doesn't have to
control means
actively
he
or
has majority ownership,
majority ownership.
and
Okay, that
he
yeah,
he gets to dictate what to do. He doesn't have to, but he gets to if he wants to,
and he chooses to hopefully not.
and depends on the
Yep,
management.
yep. But it kind of makes sense, I guess, in a way because as your assets grow, you have a lot more money, and you have a lot more money, you can buy out companies outright. And if you can buy out companies outright, then all the profits from that company can be reallocated to different
Depending
places.
on
Yep.
your yeah, you get to raise that capital. That's interesting.
C's, I'm thinking about C's Candy right now,
No, he's not even thinking about Seas Candy.
But I'm thinking about C's Candy as a
Yeah.
good example, right? It's like that's perfect. He buys out the company. Okay, he knows how much to expect every year. He reallocates the capital to other places.
And he bought Berkshire what last year.
Oh, he bought more.
No, he
You mean?
bought initially like 62 is when he made the purchase, right?
Right, right.
The first stock, and
Yep.
because of Berkshire, he was able to buy Geico.
Yeah.
I think like even though it was a crappy business or whatnot, it wasn't as good. I mean, those earnings got him Geico.
Yep. Yep.
Miscellaneous. We're starting off the year. Wait, how much is this? Okay, I think we're almost done. It says we're starting off the year with the net assets of 17 and a half million dollars. Wow.
Wow.
A rapid increase in asset always raises the question of whether this will result in a dilution of future performance. To date, there is more of a positive than inverse correlation between size of partnership and its margin over the Dow. This should not be taken seriously, however. Larger sums may be an advantage at some times and a disadvantage at others. My opinion is that our present portfolio could not be improved if our assets were $1 million or $5 million. Our idea inventory has always seemed to be 10% ahead of our bank account. If that could change, you can count on hearing from me. Wow. They're saying we have so much money. Does being big slow you down? Not really. That's what it's saying right now. It's like, I haven't seen that. People talk about this. And right now, I mean, the trend has been I'm finding more things to invest into, but I just don't have enough money. And that's been the case since, I guess, for the past 7 years. So Buffett definitely does not think he's too big.
Yep.
Susie and I have an investment of $2.3 million in the partnership. Dang! For
Wow.
the first time, I had to withdraw funds in addition to my monthly payments. Well, he gets monthly payments. He talks crap about other people taking monthly payments, but he takes monthly
I
payments.
mean,
So
from his own, I guess, account, which is
correct,
not.
correct. But
Yeah.
overall, he says, like you shouldn't really like you can't take monthly payments, but probably shouldn't do it. Most people probably shouldn't do it. But I mean, clearly, this is his only job. Other people have other
Yeah.
jobs.
Yeah. Yeah.
But it was a choice. But it was a choice of this or disappointing the IRS. How they have to pay taxes. Like disappointing the IRS. Susie and I have a few non-marketable, less than 300 holders, securities of nominal size left over from earlier years, which in aggregate are worth perhaps 1% of our partnership interest. In addition, we have one non-marketable holding of more material size of a local company purchased in 1960, which we expect to hold indefinitely. What? What did they buy in
What
1960?
is that company?
Aside
Hmm.
from this, all our eggs are in BPL basket, and they will continue to be. I can't promise results, but I can promise a common destiny. I like that. In addition, that endless stream of relatives of mine, consisting of my three children, mother, father, two sisters, two brothers-in-laws, father-in-law, four aunts, four cousins, and five nieces and nephews have interest in BPL directly or indirectly, totaling $1.2 million.
Wow, that's family support right there.
Bill Scott is also in with both feet, um, having an interest along with his wife for $237,000, a large majority or their net worth. Interesting. Bill has done an excellent job, and on several or our more interesting situations going into 1964, he has done the majority or the contract work. I have also shoved off on him as much as possible of the administrator work. So if you need anything done or have any questions, don't hesitate to ask for Bill if I am not around. Beth and Donna have kept an increasing workload flowing in an excellent manner. During December and January, I am sure they wish they had found employment elsewhere, but they always manage to keep mountain of work shipshape. Pete, Marwick, Michelle have done their unusual excellent job of meeting a tough timetable. We have instructed them to conduct two surprise checks a year. Oh, I think that's their auditor,
Oh, okay.
accounting firm, rather than one as in past year on our securities, cash, etc. In the future, they are relatively inexpensive, and I think make a good deal of sense in our financial organization. Within the next week, you will receive a tax letter from BPL that you need for 1963 income tax, an audit from the accounting firm for 1963, setting forth the operation financial positions of BPL as well as your own capital account, a letter signed by me setting forth status of your BPL interest in the first January. This is identical with the figure developed in the audit. A Schedule A to the partnership agreement listing all partners.
Hmm.
So they actually get to know all the partners. Let me know if anything is clarifying as we go. There is more likely of missing letters and names skipped over, no figure transposition, etc. Speak of if it appears we might have heard. Our next letter will be about July 15th, summarizing the first half. Cordially warning, Buffett.
Hmm. Awesome.
All right. Thank you, everybody, for bearing with us and listening and going on this letter ride.
Yeah, it's
Woohoo!
exciting. Next time it's 1965.
4.
1964. Okay.
First half of 1964.
Awesome. See you then.